How's everyone doing tonight? My name's Parker Roberts, and I'll be your host here for how to sell without paying taxes and the ever importance of a 1031 exchange. So happy to see so many familiar names on the call tonight. And as always, I want to make sure that you all can hear me loud and clear before we dive into all these nitty-gritty details of a 1031 exchange. So if you all can hear me, you'll have a chat bar on your right-hand side. If you can go ahead and just type in, let's just do your first name tonight. Type in your first name just to make sure you all can hear me before we get started. So let's see here who is. All right, we're getting some good feedback here. John, thank you. We got Steve, thank you so much. Royce Tabar, how's it going? All right, sounds like we got a good crowd here, and you guys can hear me loud and clear. So, like I mentioned at the start of this presentation, my name is Parker Roberts. I'm one of the real estate advisors here at Marshall Reddick Real Estate. I'm licensed here in California as a realtor. I grew up in a real estate family, so real estate's been in my blood since birth, as my dad is in the development side of things. And in college, I studied finance at the W.P. Carey School of Business. So shout out to you Sun Devils on the call tonight. But most importantly, I'm a real estate investor myself. So I'm constantly thinking about the future of how I want to accomplish my short-term and long-term goals, and tie it into this presentation with how to kind of jumpstart my portfolio building through this 1031 exchange. So that's what we're going to cover tonight. I mentioned I'm with a realtor here in California. So whether you're looking to buy a primary residence or even for you savvy investors looking for the great deal here in Southern California, I can absolutely help you out and would love to have a conversation with you as well. But a little bit about Marshall Reddick Real Estate, as we have a lot of meetup people on the call tonight, and the long-term members, a nice little refresher course here, as we are a real estate brokerage. We cover Southern California, basically, with our local brokerage for investment property or primary residences. But our niche is really residential real estate and investment property, for that matter. Not only here in California, we're in about 16 hand-selected markets across about 7 states in the U.S. that range from Texas, Florida, Indiana, Tennessee, Idaho, Nevada, Arizona, and here in California, just to kind of breeze over them as well. We're also a property manager here locally, and we work with great property managers in these other states that I just mentioned as well. And our third service is our private money lending division. So that's for individuals that cannot qualify for conventional financing, whether you have more than 10 mortgages, purchasing in a retirement account, you have to use non-recourse financing. Now that's a whole nother topic which we've covered recently that I'd happy to share with you on how to invest on that side of things as well. But lastly, I bolded it down here at the bottom. I'm not sure if you can see my cursor here, but we work with the best teams in all aspects of real estate. One of which we're going to hear from tonight is our 1031 exchange qualified intermediary, which is a tongue twister, and she, Dino Champagne, is going to go through all the nitty-gritty details on the 1031 exchange process, when it makes sense, and why it's so beneficial for us real estate investors. So I wanted to get the juices on because we all know there are 2 certainties in life. Let's read them out loud together here. Is death and taxes, right? Quoted by the great Benjamin Franklin here. And tonight, we're going to show you how to sell property without paying those, or one of those, certainties in life. And then the second quote I wanted to start out with is kind of near and dear to all of us real estate investors. It's not about how much you make, it's about how much you keep, okay? You want to keep Mr. Benjamin Franklin's in your bank account, in your pocket. And again, tonight we're going to cover how to keep many, many, many of these Benjamins in your bank account when selling property. So I want to make sure you're all awake after a long day at work or with the kids and the family. So I'm going to launch a poll question here. It's an interactive webinar tonight. So let's get this first one started. So on your screen here, you'll see the question, which of the following best describes me? I have property with equity I'm considering of selling. I own property and not yet in a position. Or option 3, I don't own property yet and just want to learn a little bit. So go ahead and choose which one best describes you. Again, as previous webinars are held, these answers are completely anonymous. It's just for interaction for you folks and get to know you as well. So let's go ahead and cast the last amount of votes in here for the last minute people. I'll give you 5, 4, 3, 2, and 1. All right, I'm going to close this. I'm actually going to share the percentages with you folks to see what we got in the crowd. So in third place is option 2 with 21% of the vote. I own a property but not yet in a position. The second place one is I don't own property yet and just want to learn. And then in first place with 47%, I have property with equity I'm considering to exchange. Well, for you 47%, you came to the right webinar. So let's dive into those details on you 47% and the rest of you folks on the 1031 exchange process. So it's my pleasure to introduce you to the best name in the entire world and the business. She is a wealth of knowledge and helps many of my clients out with this exchange process. Her name is Dino Champagne, and she is going to run you through the 1031 exchange process and how to sell without paying taxes. Dino, go ahead and take it away.
Good evening, everyone. It's my pleasure to be able to present the topic this evening for Marshall Reddick. I have to say that I actually have been an investor with the Marshall Reddick Group. It was like 15 years ago when I had my first property, so it's been a while. What I want to do this evening is take you through the basics of the 1031. A little bit about my background. I've been with asset preservation, actually going on my 15th year now. As a company, we are a national 1031 qualified intermediary. We have facilitated exchanges to the tune of over 160,000 nationwide. We're actually a wholly owned subsidiary of Stewart Title. That's our parent company. And why is that important? Because my industry is currently not regulated. So you want security when you're choosing a qualified intermediary. I cover the Los Angeles, the Inland Empire area, which is basically San Bernardino, Riverside County, Ventura counties, but I've helped the Marshall Reddick network throughout the nation in answering their questions and assisting with their exchange. I left a little thing there saying I'm an avid golfer. I still have a day job, so therefore my golfing abilities are a little suspect. Okay, so what I want to do, so here's, well, I guess here's an example, Parker, of an investment in Austin, Texas that has gone through an exchange. Is that correct?
Exactly. So this, folks, is actually our Vice President, Scott Pastel. This is his brother, Alex Pastel, in which he bought a property out in Atlanta, Georgia. He gained some equity over the time he held the property, and it aligned with his goals to sell that property and exchange it for a property in one of my favorite markets of Austin, Texas. So I think, Dino, you can kind of take it away with the details on this transaction and go from there.
Okay, well, you know, in a basic exchange, which we're going to cover today, I mean, you have a relinquished property, and the good news is you can exchange within the United States. So in this transaction, you can see that they went from Georgia to Texas, and that totally works for the 1031. And we're going to go through the process of how that plays out for those that have never experienced the 1031, and then for those that have actually gone through this type of transaction, a little refresher course. So let's talk about what we're going to cover this evening. We're going to talk about what's the capital gain taxation. So there's taxes when you own an investment property and when you go to sell the property. We're going to cover what those tax rates are. I'm going to give you an example if somebody sold a property and then just went out and bought a property to what the value of an exchange, can be for them. In any transaction you have, there's always going to be pros and cons. So we're going to address the pros and cons for doing an exchange. We're going to go through exchange terminology. in every industry, there's its own lingo. So in the 1031 world, we have our lingo as well. So I'm just going to do a quick little rundown of the kind of terms that you will hear in a 1031 transaction. I'm going to take you through what IRC Section 1031 is and what does not qualify for a 1031. We're going to discuss what is like-kind property. We're going to talk about the exchange equation because there's certain rules that you have to comply with in order to defer the tax. I will take you through the process itself, the identification rules, and then we circle back again about the role of the qualified intermediary and how to do due diligence on the industry. And then question and answers will be at the end. Okay, so let's, second poll.
All right, make sure you guys are awake for the second time here. Second poll question, as we just went through the outline here. I know a lot of you are savvy investors here, so this might pertain to you and your current portfolio, which is right on your screen here. Have you performed a 1031 exchange before? Simple yes or no answers here, nothing too crazy. And go ahead, it looks like the majority is clicking in so far. We will give it 5, 4, 3, 2, and 1. Okay, I'll close out the poll, and again, I'll share these again for the folks that are tuning in from their phone and can't see the screen. The question was, have you performed a 1031 exchange before? And as you can see on your screen here, about 92% have not done this yet, and then 8% have. So this is a perfect refresher course for you 8%ers, and then for the 92%, you may be in a position to do this 1031 exchange, and Dino is going to cover it from here on out. So I'll go ahead and hide this and give it back to Dino to take it away on the 1031 exchange.
Thanks, Parker. Okay, so let's talk about taxes that a real estate investor is going to face when they decide to sell their property. When you own real estate investment property, you depreciate the property, which basically, as an operation of the property, lowers your real estate taxable income. That goes back to what Parker says about the money you get to keep. So that plays an important role in that because depreciation is a non-cash expense that lowers the income while you're operating the property. But when you go to sell the property, the government has a tax associated with it. It's called a recapture tax. And that tax is at 25%. That's going to be the first tax that comes out when somebody sells an investment property. Then there is the capital gain tax. That's when you have long-term investments, which means you've held the property for a year or more. There are two rates right now for long-term capital gains, 15% and 20%. 20% will kick in if the investor makes more, if they're single and they make more than $400,000 a year and $450,000 or more for a married couple. They're going to be taxed at the 20%. Anything below that, they're going to fall within the 15% capital gain rate. Then there is another tax which is called the net investment income tax. That tax actually is associated with the Affordable Care Act, or commonly known as Obamacare. That's an additional tax of 3.8%. That tax will be assessed when the taxpayer's income is more than $200,000 if they're single and $250,000 if it's a married couple. And then you have the state of California. Now, we show California because that's where we're located. But some states do not have any state tax. So obviously that's not going to be applicable for states like Texas or Florida or Washington, Nevada, to name a few, that are non-income tax states. But in California, we have tax. And the tax rates here in California can range 9.3 to as high as 13.3. So those that are investors in California that might own property, say, for example, in Florida or in Texas, and you go to sell that property, as a California resident, believe it or not, you're still going to be subject to California tax, even though Florida or Texas is not going to assess you with a state tax. So these are the types of taxes that an investor is going to be faced with when they sell a property. Now, what I want to go through now is to show you how this works in a transaction. The first thing in calculating gain is we need to know what was the original basis in the property. So what did you buy the property for? How much did you pay for it? When you own an investment property, there are times as an investor you're going to make capital improvements. For example, new carpet, a brand new air conditioning, replacing the entire roof. Okay, that would be considered a capital improvement. While you have the opportunity to write the check to make those improvements, technically you're not going to be writing that off on the tax return for the year that you spent the money. So that gets added to the basis in the property when you go to sell the property. So in my example here, I'm showing the property was acquired at $500,000. Then the capital improvements over the years of ownership was $50,000. So that's added to the basis in the property. Now remember I mentioned that depreciation lowers the real estate taxable income while you're operating the property. Well, it also is going to lower your basis in the property when you calculate gain. Now, the accountant is going to figure out what the depreciation number is going to be. Only the improvements to the property are going to be depreciated. So, for example, the property might have, the improvements itself might be 75% of the total. So that's the portion that is going to be depreciated. So in my example here, we're showing that this depreciation over the years of ownership ran to about $150,000. So that's going to lower the basis in the property. So to calculate my adjusted basis, I figure what did I pay for the property? I add my capital improvements. I subtract the depreciation that I've taken. So now my net adjusted basis has been reduced to $400,000. The next category, we're going to calculate gain. So gain is calculated by subtracting the net adjusted basis, the closing costs, from the actual sale price. So if I sell a property for $1.2 million, and my net adjusted basis is $400,000, and my closing costs, and the closing costs I'm referring to would be like title fees, commissions, any closing fees such as escrow. If you're on the East Coast, that would be attorney closings. That comes to say $80,000. So in this example here, the gain on the sale of this property is $720,000. Now that's not an unrealistic number, especially if you're in the California market or maybe even the New York market to add to it as well. Now let's calculate what the tax for each of these for this is going to be if they just went out and sold the property and wanted to just go buy out the property. As I mentioned, depreciation has its own tax rate. So you've got 25%. That 25% is going to go against the $150,000. So that gives you a recapture tax of $37,500. The federal capital gain tax in this particular example is going to fall within the 20% rate. Now, when you calculate gain, you separate the actual gain number itself, so 720. You're going to subtract the depreciation. So you're not going to get double taxed on the depreciation amount. So the capital gain tax of the 20% is calculated on $570,000. So that comes to $114,000. And because of the gain in this property, this is going to be subject to the net investment income tax at 3.8%. So that's another $27,360. And if you're in the state of California, you're going to be subject to an additional $81,360. So in this example here, while the gain on the sale of the property was $720,000, the taxes that are going to be due potentially is going to be $260,000. I'm just rounding at this point. Okay? So now let's look at how it plays out for when somebody wishes to reinvest. All right. So now you're in the closing stage with the escrow. So you have the sale price of $1.2 million. You have the closing cost of $80,000. There's never been a situation where the lender has said, don't bother paying me back when you sell this property. So if you have a loan on the property, obviously that money that's coming in from the buyer is going to be used to pay off the loan. So in this example, if the loan was $500,000, that means that the investor has $620,000 of cash that they're going to receive at the closing. If they're just going to sell the property and they want to go out and just buy, they have to earmark about $260,000 to pay the taxes. So therefore, their purchasing power is going to be reduced by the taxes that they're going to owe. So if they're going to write the check, they're going to end up with only about $360,000 of cash to put down on another investment property or investment properties. So if they have $360,000 and they get a 70% loan on the property, they can buy a property for $1.2 million. But if they decide to do an exchange, the $260,000 that they would owe to the federal government as well as the state government, they don't have to pay. It's deferred. So therefore, they would have the full $620,000 that they can put down on a property. Same loan to value. They can now buy property for $2.1 million. So this is what we call the power of exchange. It allows the taxpayer to defer paying the tax so that they can use the money to go and buy more investment property. But in order to do that, there's rules that the taxpayer has to follow to not pay the tax. So this is why 1031s are so important as an investment vehicle, because we like to call it the reinvestment plan, the taxpayer reinvestment plan, because now instead of giving the tax dollars to the government, you're going to now roll that over into property and you're going to continue your real estate ownership. So let's talk about the pros and the cons of the exchange. Well, the pros of the exchange is the fact that you get to defer the depreciation recapture tax, you defer the federal and state taxes, you defer the net investment income tax. It's an opportunity to preserve equity because, as I just mentioned, I do not have to give that $260,000 to the federal government and or the state government. So I get to use that to build my wealth. Leverage. You could have the opportunity, if you're selling an investment property that has low leverage when you sell, to buy more by utilizing leverage on the next property. You still have to spend all of your cash. We're going to get into that in a minute, but you can get more leverage on the property. Diversification, and we're seeing a lot of this in the 1031 world right now, is where the people are diversifying by geography and by asset class. So you can diversify where you're investing and by the type of property that you're investing. After you've owned the property for a while, you can potentially refinance the property to pull some cash out. You want to talk to your tax advisor about when you do that and how the implications would be for reporting any interest on that, but you have the potential to obtain some cash through a refinance, because right now they don't tax you when you pull equity out of your property at this point. Management relief. There are types of properties that you can invest in that there's basically no management. That would be something like a triple net property and or a Delaware statutory trust. When it comes to the latter, the Delaware statutory trust, if you're a hands-on investor, this is not a product for you because you don't have much control. The next thing is sometimes people use this as an estate planning tool. So they will continue to build their estate so that when they go to, when they pass away, the properties are now passed on to the heirs. And under current tax law, the taxpayer, the heirs will get a full step up in basis. So that's some of the advantage of using this as an estate planning tool. Now those are the pros. So let's talk about the cons of doing a 1031. You have to follow the rules, and we're going to go through that because there are specific rules and time restrictions that come along with an exchange. The rules are written where you don't have forever to reinvest the property. So we're going to go through what those timelines are. The other downside to doing an exchange is the replacement property basis. It comes with you to the new property. So what ends up happening is that if you sell an investment piece of property for $500,000 and you've owned it for 25 years, and you buy a new investment piece of property and you buy it for the $500,000, your depreciation schedule remains the same as it was when you sold the other property. You do not get a brand new basis in the property. So that is one of the downsides for doing a 1031. The lack of liquidity, because in a 1031 you have to purchase real property. Any money that you touch or take is going to be taxed to the amount of gain recognized. It's important when you're considering doing a 1031 that you always consult your tax advisor, because there are times where investors might have some suspended losses. And if you do an exchange without consulting your tax advisor, you might not be able to, use those losses when you go into the next property. And I shouldn't say might not, you cannot. So you want to make sure that you talk to your tax advisor. That way, if you have some suspended losses, maybe you can take some cash. So there's some strategies behind that. But if you don't talk to the tax advisor, you have suspended losses, and you roll into the next property, you're not able to recognize them at that point. And then there's always the possibility of higher taxes in the future. We don't know what that's going to look like. And then the other key component is you're not going to ever hear me say the words tax-free, because there is nothing tax-free about a 1031. It is truly a tax deferral mechanism. Okay? So now, what I want to do is take you through some of the terms that you would hear in a 1031 transaction. Okay, there's a term that you're going to hear, and it's called boot. So for those that have experienced the exchange before, you've heard this term, and I like to say it's not the shoe sale at Nordstrom's or Macy's. Boot means taxable. There are two types of boot in a 1031. There is cash boot, which is the more obvious, which means you didn't reinvest all of the cash. And then there's mortgage boot, which means you did not replace the debt. We're going to go a little bit deeper into this when we start getting into the mechanics of the exchange. But there are two types of boot, cash boot and mortgage boot. The other term is constructive receipt. That's important because in the 1031 code, you cannot touch your money. So if you sell a property and you basically say, well, I'm not touching my money because I'm having the closing agent turn around and wire it to the next closing agent, I've done an exchange, that is not accurate if you do not have a qualified intermediary. That would be considered constructive receipt, and that ends up being taxable. There's a term called direct deeding, and this comes up a little bit often because if you've been involved in a 1031 transaction, there's language that gets inserted to the contract for the qualified intermediary, the accommodator, to be assigned, because we have to be assigned into the contract. So there's a specific role that we play. The good news is that when we're assigned into the contract, while we're stepping in the shoes of the seller of the what we call relinquished property, we do not have to physically go on title to the property. We're able to tell the closing agent to deed the property directly to the buyer as though we were not there. So direct deeding is a very simple process when it comes to the exchange. The exchanger, basically, that's the taxpayer. The exchange agreement, that's the documentation that an exchange company is going to prepare that is going to transfer the property that you're selling in the relinquished property side and on the buy side. The exchange agreement, I like to say, is the linchpin, the duct tape that keeps it all together. Without an exchange agreement, you do not have an exchange. The identification period and the exchange period. We're going to go through this, but to give you a quick overview, you have a certain number of days to identify. That's 45 days. The exchange must be completed within 180 calendar days. The time frame for these periods begin at the closing of your sale. The term like-kind property means basically that you're selling investment property and you're buying investment property. There's certain things that you cannot exchange into that's not considered like-kind. The qualified intermediary, that's what I am. We would be the one facilitating the exchange, selling the relinquished property to the buyer, buying the replacement property, and then subsequently having escrow deed the property directly to the taxpayer that's doing it. We're going to restrict the proceeds from the taxpayer. They cannot touch their money during this period, and we're going to comply with all the other Treasury regulations that are mandatory under the tax code. The relinquished property is the property you're selling, and the replacement property is the property that you're buying. So that's the terms that you're going to hear in a 1031 transaction. Now let's talk about what does the code say. The code states that there is no gain or loss that shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held for either productive use in a trade or business or for investment. Now that's a mouthful, okay? Generally I say it really fast when I'm doing normal seminars in person, but on a webinar probably a little difficult. All right, so what that means, and I'm going to break it down, is no gain or loss shall be recognized. It means it's tax deferred. It's realized, but you're just not having to write the check. on the exchange of property. The exchange takes place between the qualified intermediary and the taxpayer. That's why our role and our function in this is so critical. The property that you're exchanging must be property that's held for trade or business or for investment. Since we're on a Marshall Reddick webinar, you're going to be more in the investment arena, I would venture to guess. But sometimes you might have a car wash, or you might own a hotel, or you might own a gas station. Those are properties where you operate your business that you can basically utilize the 1031 tax code for if you're wanting to expand. Okay, so it's not solely for the investor, but because people do operate their businesses, and when they want to grow, they can utilize this code to expand and buy larger quarters, headquarters to operate out of. Now, the property that you're exchanging must be property of like kind. We're going to go into that a little bit deeper. But the use of the property also has to be for trade or business or for investment. One of the things you cannot exchange into is your primary residence. So if I was selling an investment property and I wanted to buy a property that I was going to move into immediately, that will not work for an exchange. While we may feel our primary residences are investment, for tax purposes, they're not. So you cannot exchange into your primary residence, at least not immediately. So that's the first sentence in the code. Now let's talk about what you cannot use that does not qualify for an exchange.
Now before we get to that, I'm getting some feedback that some people may have lost audio on the call, so I'm going to do another sound check here. Apologize for the redundancy, but if you can hear Dino and me, let's put in the, let's just put hi. How about that? So type in your chat bar hi if you can hear Dino and myself loud and clear. Oh, that's wonderful. Okay, sounds good. Well, Dino, apologize for the interruption here, but wanted to make sure all these folks are getting the information here. So let's continue on.
Okay, so you want to flip slides for me now? Okay. So what does not qualify for an exchange? Stock and trade or other property primarily held for sale. So if someone goes and buys a property, they're intending to fix it up and turn around and sell it. That would not qualify because their intent is not to hold. Their intent is basically to fix and flip or to build and sell. So that would not qualify for an exchange. Stocks, bonds, or notes do not qualify under the 1031. Other securities are evidence of indebtedness or interest. The next one, interest in a partnership. This is really interesting because sometimes people, when they want to buy a property with someone else, they have to be careful of the formation, what they're doing there when they want to buy the property with another party. If you're buying the property as tenants in common, that will work for the exchange because you have your undivided interest, they have their undivided interest. But if the two parties, for example, want to get together to buy a property, and let's say one of the parties is doing an exchange and maybe the other isn't, and they say, well, let's form a partnership and we'll take title in a partnership, and then that way we can operate the property in the partnership entity. That will not qualify for the exchange for the party coming out of an exchange because a partnership interest is not like kind to fee because the partnership is the taxpayer that would ultimately own the property, not the members themselves. So that gets really tricky. We're not going to cover all of that tonight, that's for sure. But when you find yourself in those circumstances, make sure that you're talking to the qualified intermediary and also getting tax advice along the way. The next thing is certificates of trust or beneficial interest, and then a chosen action, which is basically a legal right to something, but you don't own the property. So these are the items that do not qualify for 1031 treatment. Now, one of the big questions, or often asked questions, I should say, that comes up is when you talk about the intent to hold for investment, how long am I supposed to hold? What does the tax code say? Does the tax code say I have to hold a specific period of time? And the answer to that is there's nothing in the code that mandates a specific holding period. This is why your tax advisor is going to be very critical in the analysis of your transaction. Now, there are two schools of thought. Okay, one would be that you hold the property for 24 months. That way, there was a private letter ruling that came out in '84 that addressed the issue. But also, there was a revenue procedure that came out in 2008 that addressed, the IRS gave a safe harbor to vacation homes transactions, and they said if you've owned the property for 2 years, I mean, obviously it has to be an investment property and treat it as a rental, not where you're occupying it for personal use, because that would not qualify. But in that revenue procedure, it came out and it said 24 months. So that can give you some guidance there. Some tax advisors might say a minimum of 12 months because it straddles 2 tax filing years. And as I mentioned in the beginning, when you have an asset that's more than a year, then you are subject to, you're able to get long-term capital gain rates. So while there's no safe holding period, it's about the intent. So what was the intent when you acquired the property? So 1 year for more aggressive tax advisors might recommend, 2 years for probably more conservative. But there are times, and there have been examples where somebody has owned the property for, say 12, 15 years, did an exchange thinking they were safe when their exchange failed because their intent was never to hold the property for investment purposes. Their intent during that entire period of ownership was to develop it for resale. So this is where timing is only one aspect of it, but it's not the only thing. So there's other factors. Again, very important to make sure that you're having your tax advisor guide you through this process. The next thing that comes up is about like-kind property. Sometimes I'll hear people say, well, if I'm selling a duplex, that means I have to buy a duplex, right? Because it's like-kind to what I sold. And as I mentioned earlier, when we say like-kind in a 1031, it's investment property for investment property. So an investor can go from an apartment building to a shopping center to an office building to 30 single-family rentals, raw land to a single-tenant triple net. There are a lot of different avenues for the like-kind to be qualifying in a 1031. It has to be real property, and it must be investment property to qualify for like-kind. So pretty broad. Now when we talk about, remember I told you there's the cons of doing a 1031 or the rules that you have to follow. So now what I'm going to take you through is what has to happen in order for you to have the ability to defer the tax. One of the rules is that in an exchange, it's not just your gain that is reinvested. It's not just the cash coming out of the transaction that is reinvested. In order to defer the tax, the investor must buy property equal to or greater than their net sale price. They must spend all of the cash coming out of the transaction, and they must replace any existing debt. So here in this example, we're showing they sold the property for $900,000. The existing loan on the property is $300,000. The closing costs were $60,000. So the cash coming out in this transaction is $540,000. Now they go and buy the replacement property. The replacement property in this example is $1.2 million. So in this example here, they put $540,000 down. They received a loan of $660,000. So they met the requirement. Want to hit the next slide, Parker? So as you can see, there's no boot because they reinvested all of the cash and they bought property equal to or greater than their net sale price. They met the requirement. Now there are instances where people might buy less than what they sold for. So in this example here, they sold for $900,000. They bought for $700,000. They put $440,000 cash down, so that means $100,000 cash was not spent. They went down in the loan value by $40,000. So remember I said there's 2 types of boot, cash boot and mortgage boot. So this particular example, while it's probably not a logical one, it gives you the example of what mortgage boot would look like. So they have $40,000 in mortgage boot. They have $100,000 in cash boot. So they have a tax liability. They're going to pay tax to the amount of gain recognized on $140,000. Now the biggest question people will go, well, why do I have to pay tax on the mortgage boot? Because I didn't receive any cash. And that's correct. You did not receive any cash. But when you think about what a mortgage is, a mortgage merely is cash. It just belongs, the money just belongs to someone else. And that's why it needs to be replaced when you buy on the replacement property side. I always laugh and say that it would be, the lenders would be ecstatic if that wasn't the case, because everybody would be refinancing their properties before the end of a deal. So you do have to replace the mortgage boot, the mortgage on the replacement property side. Now here's something that needs to be you have to watch out for in a transaction. And I had a call today that it wasn't quite this bad, but it does happen from time to time, where sometimes an investor, because they're buying higher than what they sold for, thinks they're completely safe. So in this example here, the investor is buying for $1.1 million. They spent $400,000. They put down $400,000 for the cash into the property, and they got a loan for $700,000. While on the surface it may look like this transaction is fine and it's not going to have any boot issues, it's quite the contrary. You cannot keep cash and increase the debt and defer the tax. You must spend all of the cash. So when you're doing an exchange transaction, it's very important to make sure that you're watching how much loan you're getting to how much cash you have to spend. And this does happen because sometimes there's a lot of great loan programs out there right now, and you can get swept up in the moment. But when you're doing an exchange, you must spend all of the cash. If you don't, it's going to be taxable boot. So these are the exchange equations that you have to deal with when you're dealing in an exchange transaction. So those are one of the rules. Commonly comes up, what closing costs are typically acceptable at closing costs in an exchange? Well, it would be anything that's used to transfer the property, a direct selling cost, if you will, which would be a real estate commission, title premiums, the closing or the escrow fees, any legal fees, notary fees, recording fees, the qualified intermediaries fees. Those are acceptable closing costs in an exchange transaction. Now, there are times where you're going to have closing costs in the transaction, but they could potentially cost you in taxes. So let's talk about what is not typical and could be a boot issue. Prorated rents and security deposits. When you have investment property, and if it's an apartment building, for example, there's going to be prorated rents. There's going to be security deposits. There are a lot of times where the negotiations between the parties, it says, well, just go ahead and credit the buyer with the prorated rents and security deposits. The problem with that for the party doing the exchange is that's money that's not coming into the exchange, and that will be taxable boot. So prorated rents and security deposits are not a function of the transfer of the property. While it may be a function of the property, the sale of the property, those are operational costs. Okay, so that, therefore, it would be taxable boot. Any points, prepayment penalties, and the like. That gets a little gray in some areas, so you have to deal with your accountant to see how it ends up with the prepayment penalty issues. Paying for the buyer's closing costs, very common. That's going to be a taxable boot because, again, that's not coming into the exchange. Could these costs be offset? Yes, but we'll let the accountant do that at the end of the day. Any lender policies, impounds, property taxes, insurance. As you can see, this set of examples here is more about the operation of the property and the lending aspects of the property, not about the transfer of the property. So when it comes to these situations, they will come up in an exchange. You just have to understand what may be taxable and what may not. Now let me take you through how the exchange process works. First, when you decide that you're going to sell your investment property, because in a 1031 exchange, it starts with the sale, and then it ends with the purchase. Now, there is an item called a reverse exchange, which I will not get into today, but obviously it's being done in reverse. Very expensive and very difficult transaction to get done. But when you're doing a forward exchange, it starts when now you're going to list the property. Okay, so you call Parker and you say, I want to list the property now. I always recommend that you talk to two people when you're doing that besides the agent. You're going to talk to your tax advisor to determine what your gain will be when this property sells, and then you'll talk to somebody like me, a qualified intermediary, who is going to tell you how the process of the exchange is going to work and the steps that need to be taken. You have a buyer for the property. Now you open up escrow. That's when the qualified intermediary, the accommodators, documents physically now come into a transaction. I'll get a phone call well in advance of somebody even selling the property. And there's really nothing for me to do at that point other than answer their questions. But once the property is under contract with a buyer, that's when I now physically get involved. And so what happens there is I would be asking, who is handling your closing? I need their contact information. I would contact the closing agent, and I'm going to request certain documents from them. I'm going to request a copy of the fully executed purchase and sale agreement. I'm going to request a copy of the title commitment or preliminary title report, their instructions if they prepare escrow instructions. Once they send that information to me, then our staff now prepares the exchange documents themselves. We cannot prepare exchange documents unless we have a fully executed purchase and sale agreement. Now we're going to prepare the exchange documents and the notice of assignment documents. Those documents are now going to be sent to the closing agent. They're going to be sent directly to the taxpayer themselves. And I'm talking specifically how we operate. You must sign the exchange documents, okay? Us preparing the documents and not signing them does not constitute an exchange. So you have to sign the documents. And I know it probably you're going, well, why would you say that? Because there's sometimes people think because they received it, they're good to go, and they're not. Once you sign those exchange documents, now the qualified intermediary, we're now officially in your transaction. We have now stepped in your shoes as the seller of that property. When the escrow goes to close, the deed is going to go directly to the buyer. That's the direct deeding part I mentioned earlier. So when a buyer is being asked to cooperate with the seller's 1031 tax-deferred exchange, all that means is that it's allowing the qualified intermediary to step in the shoes of the seller. It has really no impact on what's going to happen for the buyer because it's cooperation language. It is not a contingency. Unless you make it one, then that changes the whole flavor. But in a regular cooperation language, so the buyer, there's nothing really impacts the buyer at all. So then the deed goes directly to the buyer. The money from the sale is wired directly to the qualified intermediary. This is when the time frame for the exchange now officially begins. Another one of those items on the con section of doing a 1031, specific guidelines and specific time frames. When you do an exchange, once your escrow closes on the sale of that property, you have 45 calendar days from the date of closing to identify any property or properties that you would like to acquire. After the 45 days, you have an additional 135 days to complete your purchase. So an exchange from beginning to end is 180 calendar days. Now there is another section to that. We're not in it right this time of year, but it says the taxpayer has 180 calendar days to complete their exchange or their tax filing date, whichever is earlier. That discussion comes into play toward the end of the year after October 17th through December 31st because of when we file our tax returns. But as you can see, you have 45 days plus 135, so you have to complete your exchange within 180 calendar days. I'm going to talk about the identification in a minute, but what happens now on the purchase side is you get under contract with the property that you would like to purchase. We have to know that you're in contract. Believe it or not, people do this and they forget that you have to let us know. Our exchange documents on the buy side also have to come in. You have to execute those documents. Then we're going to, when you're getting ready to close, we're going to wire the money into the escrow that's closing, for the closing. The deed is going to go directly to you at the completion of the exchange. So that's the cycle of the exchange. It seems very simple in a web, in a PowerPoint on a webinar, but it can get a little interesting while you're through the transaction because there are a lot of moving parts. But basically, as you can see, what happened here, I was the seller of the property as a qualified intermediary. I was the buyer of the replacement property, never touching the deeds to this property, only holding the money during the process, and the money we're holding was used solely to buy the replacement property. So that is the flow of the exchange. Now, when we talk about identifying, there are 3 rules. So let's talk about what that means. The government, when they wrote the code, they give you 3 options to identify. You only get to choose one of the 3 options. The most commonly used rule would be the 3 property rule. Now, when we talk about identifying, I like to say that there's the technical and then there's the practical aspects of this. The technical aspects of identifying basically means that you're going to fill out a sheet of paper, and there's an example later, but you're going to fill out a sheet of paper and you're going to put the address, the city, and the state of the property that you're buying. That's the technical aspect of identifying. The practical side would be that you probably should be under contract with one, 2, or 3 of those properties that you have on your list, because you can only purchase what you have identified. And that's why the challenge in the exchange is the first 45 days, because you're going to fill out that list in hopes that you can close on the property that's on there. So planning is really important. Okay, and this is where Parker and they understand how this plays out, and they're on top of all this. Okay, so you have the 3 property rules. So it means you can identify physically 3 addresses. Doesn't matter what the dollar amount is. If you wish to identify 4 or more properties, now you're going to start defaulting to the next 2 rules. The first rule that would be you default to would be the 200% rule. The 200% rule will allow you to identify 4, 5, 6, 10, 30 properties. However, when you add up the fair market values of those properties, they cannot exceed 200% of your sale price. So if you sell something for $500,000 and you identify 6 properties, when you add up the values of those properties, it cannot be more than $1 million. And then you decide which properties you're going to buy within that list. But that restricts you by the dollar amount. That's a tough rule to use if you're selling in a high-valued area and you plan on buying in the same high-valued area. We see the 200% rule where it's successful if somebody's selling in a high-valued area and they're going and they're buying a 15, 20, 30 single-family rentals in various states where the rental market, where the properties may be 100,000, 150,000, or the like. Then the 200% rule can be very advantageous in that situation. But if you're staying in a high-valued area, selling in a high-valued area, the 200% rule is probably not going to work. The next rule allows the taxpayer to have unlimited number of properties, and the dollar amounts don't matter. However, you must close on 95% of the total value of the property that you've identified. So basically, you have to buy everything on your list. Not a rule you go toward, okay? Not a very, very dangerous rule to use, because if you go below it, you can end up invalidating your exchange. So those are the 3 rules that you get to choose from. So which rule is going to be applicable is going to depend on what you're selling, where you're selling, what you're buying, where you're buying. Now let's look at what we mean by identifying. It has to be in writing. Okay, so you can't call and leave a voice message and saying I'm buying 123 Main Street, Austin, Texas. That's not going to work. It has to be in writing. You must have the address of the property or the APN number. So it has to be unambiguously described. City and state. You have to make sure that's on there. There are times where we'll get identification letters and then the people will forget to put the state on. You've got to get the state on there as well. It has to be hand-delivered, mailed, telecopied, or otherwise sent. Somebody said, what is telecopied? I said, well, these rules were written a long time ago. But you can fax them in, scan them in, okay? But it has to be done by midnight of the 45th day. And if the 45th day falls on a Saturday or a Sunday or a holiday, there is no reprieve. You still need to get it in by that time. And then it's delivered either to the qualified intermediary or a party that's related to the exchange but is not disqualified. 90% of the time, the identification is going to come to the qualified intermediary. This is what we see in our world. I always recommend that if somebody's identification falls on a Saturday or a Sunday or a holiday, that they get the identification letter in during business hours before. Because if there's any problems with how they completed the identification letter, it can get fixed. If if your identification is due on a Sunday and you send it in Sunday night, and then the next business day they come in and look at it and there's a problem, there's no alterations that can be made at that point, and that could be very, very problematic for the exchange. Okay, so let's take a look at what the identification looks like. It's a form. Our company provides you with a piece of paper, okay, and it outlines what you sold, when your 45 days is, when your 180-day period is. But you're physically going to write in the addresses, as I have an example here. You're going to sign it and you're going to date it. This is an example of the 3-property rule. If I'm just identifying 3 properties and I'm buying them by myself, then I do not have to put in the dollar amount. If I'm buying them with someone else, I'm buying a percentage, and I would have to fill in that percentage and or dollar amount. The next example is the 200% rule. This is where I've identified 6 properties here. And if I sold for $900,000, in this example, when you add them all up, I've got $1,780,000. So I'm well within the guidelines of the 200% rule, so I can buy whatever combination of properties to make my $900,000 exchange. So this is what an identification letter looks like. Sometimes people wonder, what is it? This mystery thing. Okay, it's pretty straightforward, but very critical. So what kind of documentation would you see in an exchange? The exchange agreement, the assignment agreement, because we have to get assigned into the contract, the notice of assignment, that goes to the buyer, notifying the buyer that we're being assigned into the contract. We set up accounts to put the money in, and then if we have security of funds instruments, for example, with our parent company. You're going to see the settlement statement. So basically the closing statement provided by escrow. If there's any withholding, state or federal, there's forms there, 1099. So those are the types of documents that you're going to see. So generally when somebody is doing an exchange, you're going to get a huge package from the closing agent with all your documents that you're doing within your own transaction. And then the qualified intermediary is coming in with a whole nother set of documents. Our documents are run about 27 pages. So there's a lot of paperwork that goes in with all of this. But when you stop and think about why you are doing the exchange, it's in order to preserve your equity and to grow your portfolio, to grow your wealth as an investor. So there's going to be some, there's going to be some challenges along the way. I'm not going to pretend that there's not there. But it's worth the effort, to try to defer the tax so you can reinvest and end up, again, growing your portfolio. Now, the next thing is sometimes we're seeing people right now wanting to do what's called a multiple property exchange. What happens in a multiple property exchange is in this example here for this slide, we're talking about where somebody will want to basically consolidate. So if I have 3 properties that I'm thinking of selling and I want to put them in one exchange to buy one, I can do that. That's not an issue. It's allowed in the exchange. The challenge in this type of transaction is that the time frame for the exchange will begin at the closing of the first property. So therefore, when you have 3 properties, as in this example, the second and the third property, you want to make sure are going to close as close to the first property as possible. And then that allows me to go out and buy and consolidate by buying one property if that's my goal. It can get a little tricky with the time frame because that's usually going to be the biggest issue if something happens between property 2 or 3 that it's not going to close in time. And then the next multiple property exchange would be buying of multiple properties. And this is quite common. You're selling one property and you're buying multiple properties. You have to identify all these properties within the 45 days, and you have to make sure that you're closing on all these properties by the 180th day. So you can do multiple property exchanges. This is a conversation that needs to be had on each transaction just to make sure that it is going to be able to be accomplished based on the timing of the closings of the sales and or the purchases. So multiple property exchanges are done often, but you just make sure you have to watch the timing for all of that. And then, so let's talk a little bit about today's market conditions. In certain market conditions, there's low inventory. So right now it's fantastic to be a seller. The challenge somebody is going to face when they're doing an exchange is that while you're a seller in a seller's market, you're going to be a buyer in a seller's market if you're staying in the same market. Maybe if you go into other marketplaces, maybe it's not as low inventory. Maybe the inventory is a little more flush, if you will. So that's a challenge that we're seeing in the exchange industry right now. Exchange entities investing issues. One of the things that I didn't mention, but I will right now, is that when you're doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. So it's going to be very important because that's the continuity of the ownership. The same taxpayer sold, the same taxpayer purchased. There are times where vestings may look like they're different taxpayers, but they're really not. You can have a trust, you can own property in your revocable living trust. Maybe the lender that you're using will not let you buy in your trust. That's not going to hurt your exchange because your trust is revocable, it's grantor, therefore it's not a separate taxpayer. You can buy in your individual name. There's issues with LLCs. If it's a single member LLC and it's disregarded and you're buying in your individual name, that's still the same taxpayer selling, still the same taxpayer buying. So again, we watch the entity issues when we're doing exchanges. As the qualified intermediary, we're going to ask you these questions because our job here is to try to help you make sure that your exchange is going to work all the way through. You can do a partial exchange. In the example where I showed you, they sold for $900, bought for $700. Partial exchanges are okay to do. The key about a partial exchange is to make sure that you're still benefiting from the exchange when you're doing one. And the test for me on that is that if the boot, the money that you're not reinvesting, is equal to or higher than your actual gain on the sale of the property. If the boot is equal to or higher than the actual gain on the sale of the property, then you will not benefit from the exchange because you will pay all the tax anyway. If the boot is less than the gain, then you're still protecting some level of tax. So it's a very important discussion when somebody's doing a partial exchange to make sure that they're still benefiting from the exchange. The next issue we see is what's an investor and a dealer. In marketplaces where there's low inventory, people may be buying and selling. In an exchange, it's a buy and hold, not a buy and sell. So making sure that an investor's doing an exchange and you're not turning yourself into a dealer, or you're a dealer trying to do an exchange, which you ultimately wouldn't qualify for if you ended up being audited. Reverse exchanges. We talk about reverse exchanges. They're not, my word is it's not for the weak of wallet. Because when you do a reverse exchange, that means you're closing on the purchase before you have closed on the sale. These are complex transactions. If this is something that an investor is considering, this is when you need to have a discussion with somebody like me very, very, very early on, because there's a lot of complexities to these types of exchanges. And I like to say while they're available, they're not always doable, okay, because of the components that are involved in a reverse. And the other thing is when you're California, if you're selling out of California and exchanging into another state, there is a new filing requirement. It came into effect in 2014 that you have to file a form, an FTB 3840 form, every year that you own the property. That's how California's way of monitoring if you dispose of the property that you still have to pay California taxes. So that's some of the market conditions. The other thing that's going on right now, which is not on this slide, and that is tax reform. And 1031s are a part of the discussion and for potential elimination under tax reform. So we as an industry are explaining to the Washington folks that what the value of the exchange is, and trying to, see that they continue to keep this tax code if tax reform ever gets done. So that's just something that's going on right now. It's been a part of the discussion for 2.5 years, but with the movement of trying to get tax reform done sooner than later, it's definitely coming to the forefront. So we as an industry are watching it. We'll see what happens. We hope, keep our fingers crossed that they'll continue to keep the 1031 tax code. And then the last but not least is when you deal with a qualified intermediary, as I said earlier, we're not a regulated industry. When people ask, what's your fee, that's a component obviously to doing a 1031, but the exchange fees from company to company vary anywhere between $100 to $150, maybe $200 from one to the other. So the fee is one thing, but you want to just, when you're talking to somebody about putting your money with them, where do they place the funds? Are they placed in A-rated banks or above? What do they do? Whose names are the funds held in? Are there any requirements for deposits and withdrawals? What are those requirements? Are you audited by somebody outside of your company or audited at all? And then, do you adhere to the state laws that are governing the QIs? So those are some of the things that you might want to ask the qualified intermediary. As I said earlier, we're a subsidiary of Stewart Title Company. We do work with all title, all escrow companies, so we're not exclusive, that's for sure. But you have the backing of a large title company that's been around for 120 years, I think, something to that level, quite a while. We have facilitated 160,000 exchanges. We have checks and balances within our own system. And our banking has to be an A-rated or above banks. So I've answered the questions about us. So when you're out there, talking to other qualified intermediaries, just make sure that you feel comfortable with their experience and the security of your funds, because we do have your money, okay, through the exchange process.
All right, so this is the most important time for you folks. During the entire presentation, we got a lot of good feedback, which I told some of you, let's wait till the end because I want the audience to hear the topic. So let's dive into the Q&A portion of tonight's presentation. First of all, thank you so much for diving into the details on here. I learn something new every single time you speak, so thank you so much.
My pleasure.
So the first question here is, can you sell an investment property, just for sake of example, let's say single-family home, and exchange into a traditional asset like a REIT?
No. A REIT is not, you'd be buying into a share of a REIT. And in my exceptions that I said early on about what does not qualify is you can't stocks. So that would be similar to buying stocks. So even though the REIT owns real property, you do not own the property. The REIT owns the property. We do exchanges for REITs, but as an individual, you cannot exchange into a REIT. No.
Okay. And then this topic's pretty popular with the younger generation, as they own property for 2 to 3 years as their primary residence, and they rent out a couple rooms there as well. So how does that qualify for a 1031 exchange, if at all? Say you live in one room and rent out 2 other rooms of your primary residence.
Well, that's a great question. In that situation, you want to make sure that whoever's doing your taxes can give you guidance on this one. Are you reporting the income? Are you depreciating that aspect of the property? If you're not reporting the income, if you're not depreciating anything, I'm not sure how you're going to qualify because it's a primary residence. That's a tough one because it's not like a duplex where you might be living in one unit and renting out the other. So here's where I'm going to give you my line that I do not, cannot, and will not give tax or legal advice. But you definitely want to make sure that in that situation, if your tax advisor feels that you can carve out a portion, so what percentage of that property would be qualifying for a 1031? Okay, because that's how you would deal with split treatment, is if I have a duplex or if I have a triplex, I'm living in one unit, because that's a clearer example. If I'm living in one unit, what percentage value goes to my primary to the percentage value going to the investment side? So I would say that if it's able to be done, they're going to allocate a percentage as to how that plays out. But you would most likely should be reporting it on your tax returns that way, where you're getting the income. I mean, if you're not reporting it on your tax returns, I'm not sure how you're going to be able to do that.
Makes sense. Always, for the crowd, always resort to your tax professional and your CPA for your tax needs on that as well. This is a good one. I see this commonly in the conversations I have daily with people, as families typically own properties together, right? So, you know, I'll read this verbatim. Actually, my wife and I own a property jointly with my parents. All 4 names are in title. It's not a partnership. So can they sell the property and roll their 50% share into a new investment property, and the parents take their 50% and not invest into the replacement property?
On the face of it, yes, because you don't own their 50%. And as long as you're reporting, so it gets down to tax reporting. So if you're reporting your 50%, 50% of the income, 50% of the interest expense, 50% of the other expenses, the depreciation, then you can go your separate ways. If for some reason your tax reporting is different than your title to the property, and I see this often, so you want to make sure that you're congruent with it, is that sometimes people will be entitled to a property where they have 4 different names, but they're actually filing as a partnership. That would change this whole answer. So if you're reporting it separately on your individual returns, yes, you can go your separate ways. One can cash out and the other can do an exchange.
Okay, and I think we covered this one a little bit earlier on a slide, but I want to clarify this as well. Can you move between commercial property to residential property?
Yes. Yeah, as long as the residential property is investment property and not your primary residence you're looking to move in right away.
Okay. Yeah, and I think for Capel, who asked this question, you know, anything above 5 units is technically commercial property, as long as that is an investment property. It just has to be like kind to like kind, as Dino touched on earlier. So investment property to investment property.
Yeah, I think you're referring, Parker, mainly to the lending, how lending views of 5 units and above as opposed to the 1 to 4s. It's more of a lending issue, I think, yeah, than it's a 1031 issue.
Right. Okay, this one's about your fees in specific. So what does asset protection charge for the exchange process?
Asset preservation.
Oh, yes.
Please charge. Don't worry, you're not the only one. So, our standard fee is $700 for the relinquished property and $300 for up to 3 purchases. We do not charge for wiring. We do not charge for redraws. And so it's a flat fee. So it's not a percentage of the sale. My standard line is I like to say that we're the least expensive thing that saves the most amount of money in any real estate transaction.
I mean, yeah, flat fee to do all that work and to essentially step up your basis and save you capital gains taxes. By golly, sign me up, right?
Yeah, there's a lot of work that gets involved, you know, and as Parker, you've been through a couple of transactions with us, and you know how much detail and work gets involved in these transactions. So there's a lot that goes on.
Oh my gosh, so much back and forth. And this one's actually perfect. I got a lot of questions during the presentation on, Dino, how can we get in contact with you? Parker, how can we talk about an investment property together? Well, here you go, guys. Our contact information is directly on your screen. So if you are part of the 47% looking to do this 1031 exchange for your portfolio, we can go over your options, whether it's here in California or one of these out-of-state markets where it's more affordable, can get higher cash flow for sure. Let's have a conversation. If you are exploring anything 1031 exchange, you have some follow-up questions as well. You know, like I said in the opening slide, is absolutely the best in the business, and she and her team will be more than happy to go through the process with you guys. If we did not get to your guys' question, as I know there were some coming in late, we'll follow up with you guys. But I did want to get you guys on your way, as it is Wednesday night, and you probably have Wednesday night plans. So thank you, the audience, for joining us tonight. We really appreciate your feedback and your attendance. We have some upcoming events here locally in Southern California, and also an upcoming webinar as well at the end of this month. So keep up to date on our events tab. They're free to attend. You can RSVP directly on MarshallReddickRealEstate.com, and I look forward to talking with you all later on this week. So again, Dino, thank you so much.
My pleasure. Thank you for allowing me to speak on the topic. And please feel free to call me with any questions you might have. The one you don't ask is the one that could cost you money. Happy to answer your questions no matter where you are in the scheme of things.
Awesome. Thanks again, guys. Have a good night.